The Edgeless Horseman here. It's May 13th, 2022. Another eventful day yesterday in the markets and the mining sector. I mean, first of all, let's get something straight. Everything is being sold right now. Everything is being sold. There's nobody who's sitting there with a spreadsheet thinking too much about what anything really is valued and what price, how price squares up to value. Everything is being sold. This is a panic. I mean, first of all, I think almost every crypto is basically worthless. So I can understand why that's going down. But today, Bitcoin is up 10%. I think some cryptos are up like 20-30%. I don't think they should be up, most of them, or any of them. But they're up. I mean, that's just the point. That's literally how markets work. On any given day, especially in a short time frame, people are either greedy or fearful. And yesterday and for this whole week, pretty much, everyone has been fearful, and everybody has sold everything. Not thinking too much why they should sell something. They're just selling. Why are they selling? Because they fear that price will go even more down tomorrow. That's why they're selling. They're scared now, want to get out. They see something that's going down, and they start to project this is going to go down tomorrow and the next day and forever. So that obviously opens up a lot of opportunities, because there are some things that should go down 50% and should go down more after that and stay there. And typically what happens is, if something overshoots to the upside, it tends to undercut to the downside. But there are some things that are being sold right now that have no business going down in price. But that's not why people sell. People sell because everyone is selling, and they fear that more people will sell tomorrow. So there are things that should not go down. There are things that should be up a lot already that's going down even more. And when you think about it, it's like the stock market is supposed to, track the underlying economy. So if with the global recession perhaps on the horizon, it would make sense that the companies who are in that economy start to reprice to the downside. For gold and gold miners on the other hand, our economy is basically the gold price. This is the best proxy we have for the economy of gold. That's close to all-time highs. Gold miners are still near record cash flow. The gold mining sector the last 1-2 years has been better than I think it's been in decades. So if we think how that would translate to the real economy, it's like never been a better economy. And some are pricing that in. I mean, Newmont recently hit a 40-year high. Franco-Nevada, I think, had a high. Barrick has been doing pretty well. So the largest miners have been doing the best. Mid-tiers have done pretty okay. The juniors, for whatever reason, are trading like they're not even in the gold economy. And what's interesting is that it appears that most, especially juniors, they appear to follow the price of silver more than gold, even if it's a gold junior. So for whatever reason, the price of silver seems to affect investors in this space, especially the lower you go in market cap, more than gold. And that's why I've been saying for quite some time that on average I like gold juniors a lot more, because they're pretty much actually I think they've been way cheaper than silver juniors on average, typically, because the silver miners aren't doing that great right now. I mean, they're probably making a profit, producers, but at the same time there are not a lot of pure silver miners around, or even that have the majority of earnings from silver. But anyway, this is just what it is. For whatever reason, investors, the marginal investor, seems to be much more affected by silver than gold, even when it comes to making decisions regarding selling or buying gold miners. Uh, and of course, I mean, in my opinion, this is by far the best opportunity I've ever seen in the especially gold junior space. Because down here, 2015-16 bottom, the gold economy was crap. Everything was pretty much worthless. Even if you had a project, even if you had drilled up 3 million ounces, that was probably worthless on paper at the time. Even though the market is supposed to price in all eventualities, and if a market is that shit, that means it's gonna get better because supply is gonna come offline, and that's what happened. Miners went bankrupt, projects got shelved, mines went on care and maintenance, and then we had a pretty nice bull for the next 5 years. And of course, I mean, a lot of juniors just from this leg here, I mean, went up like 500% or something like that from bottom. But at the time, yes, it made sense that they were not richly valued and almost trading for free because they had nothing of value at the time. But now again, the gold business is very valuable. But now juniors, and especially the lower you go or farther out on the risk curve, so the micro cappers are starting to price in a gold business that is absolutely worthless. I've never seen anything like it. I mean, back here, this was probably before this was the best opportunity ever. Because yes, gold went down a bit, but miners went down to 2015-16 levels. So what happened? Well, like you can see, it did a V-shaped bottom, and that's what I keep telling people. I'm not buying because I'm sure the price is going to turn tomorrow, or I'm sure that miners can't go down more. No, I'm buying for what comes after the crash. You saw the same thing in 2000. You saw the same thing in 2008, 9. Let's just see here. Yeah, here. You're buying the crash, in my opinion. Well, I'm buying because it's just so cheap. But I mean, if you want to visualize it, you're buying the crash for what comes after. So nobody wants to buy during this. Nobody. But a crash is always followed by a upswing. This was a flash crash. That went, I don't know how many percent, just GDXJ went higher from the bottom. And if you bought all the way down here, sure, it's gonna feel shit on the way up, but it's like up here, just some 8 months later, every buy would have been profitable. And we have no idea. The thing I tell people is like, I can promise you this: nobody will know when the bottom is in, except in hindsight at way higher prices. But everybody thinks they will be able to spot it. When was the coast clear? If you didn't buy this because you were waiting on, you want to know what bottom is in, would that be here? Just in time for the next leg up. So when you thought, okay, yes, now we're making higher highs, this is when people plowed in, sat through this. And if they get scared shitless, sold this, then they're waiting. Because I mean, when it's back here, I can promise you that a lot of people expect it to roll lower and go down even more. And I can guarantee that as this went higher, people expect that it would go higher. So there's no way to go around it. You don't know when the bottom is in, but you know that an irrationally cheap market that's crashing will, either the civilization will end or you're gonna make money on it. So okay, how I think about, I mean, I know a lot of people are sitting on paper losses right now, and you say it's like, yeah, you need, if you're down 67%, you need 200% to break even, etc. And given that we haven't seen any inclination that anything in this sector can go up 200%. So that's, I mean, that's recency bias. Basically, you have seen no evidence of anything going up, so you start to think that it can never go up. Because let's say every rally has been sold pretty quickly. I mean, if a stock is up 15%, it's probably down 8% next day, and just keeps grinding lower and lower and lower. But that's how it's supposed to feel. But history, if you just use history as a guide, you know that it always goes back. It always comes back. No trend lasts forever in either direction. And it's like, I think this is actually even better. This is strategic metals. That's, I think this is trading at their market. Their market cap is pretty much equal to their cash position and their stock holdings. So you get 11 royalties and 100 projects for free. Theoretically, there's no risk. I mean, there is risk, but at the same time, it's like it's trading like it has a PE of 0, pretty much. And you can see since 2005, that's 17 years, you can spot the amount of times it has traded below the price it's trading now. The flash crash wasn't even able to manage to take it much lower than this. A few cents, and then, I don't know, 200% up or whatever. Obviously, this is a time to play offense. Because if you're barely taking any risk, and risk, I mean overpaying for something that turns out not to be true or whatever. So if you're not taking an evaluation risk, you de facto are not really taking any risk at face value. It doesn't get better than that. If you're buying Tesla at a P of 80 or whatever, that's a lot of risk. The future's got to become a lot better for you not to be overpaying at the present moment. While at a P equivalent of 0, it's trading like the business will be dead forever and they will never make anything out of the 11 royalties and 100 projects in the case of strategic metals. So obviously these are no-brainer buy levels, and what people are fearing right now, which I've said, people are not afraid. I've not seen anyone say that they're selling juniors because they're overvalued. Nobody even entertains that thought, I think, because they know intrinsically that it's not true. But everybody fears price. Everybody fears tomorrow. Here everybody, welcomes tomorrow, let's say. So everybody's fearful of, let's say this was a unicorn, this was the 2008-2009 crash. Obviously that didn't last for a long time, and you can see what happened after. And this was probably some kind of discovery though. But that's what happens when you have a bunch of projects. Sometimes some will hit, and this potential should be priced into strategic metals because they have so many projects and JVs, etc. But it is obviously not if it's priced at 0. So you get the potential of this for absolutely free, which is mind-blowing. So I mean, this period of time, yes, it went lower, a bit lower here for some time, then up like 200%, touched a bit lower here, up 200%. So it's like, if this is trading at a PE of 0, you already know that's gonna go up. Unless the world ends or something catastrophic happens, whatever, or management turns into absolute scumbags or whatever, you're gonna make money from this level. It's just a matter of how it happens. I can't ask for more than that. If you buy Tesla at a PE of 80, that's the opposite. That's like something that's probably gonna go down in price unless something catastrophically good happens. But that's what people want to buy. They want to buy the things that's going up in price and uh, goes up in price. And as it goes up in price, let's say this is the actual fair value for Tesla in this scenario. The more it goes up in price, the worse the future expected returns are, but the more people want to buy it because they see the momentum upwards. They see people are making money. People are getting increasingly large paper profits. And they think that this trend will just keep on going and make them happy as well. Where in reality, the future expected returns are getting worse and worse and worse and worse and worse and worse. Right now in the junior space, they're getting better and better and better because they're gonna hit this sentiment level again. So they're just, the lower it goes, the higher they will go in the future. That's just how it. That's all you need to know really. But people fear that buying this could go down here before it goes higher. It's like, talk about a luxury problem. It's like, you know for a fact that you're not overpaying. You know for a fact these juniors should be up hundreds of percent. And we'll go, if we go into real sentiment high, I mean like 2011, they're gonna go way, way higher. They're gonna be 10 baggers, 20 baggers, etc. But how on earth do you get such returns? You don't get that from buying up here. You get the obscene future returns by buying as low as you possibly can. And it's like, in light of this 2011 mania, you could buy it. You could buy this and sit at a profit. You could buy here and do a decent profit. But down from these levels, I mean, just look at how the future returns change. Okay, let's cut it off here. Okay, that's a 15 bagger. From this level, 200%. You can see the future expected returns just tick, 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 tick. And down here, I mean, look at it. From this level here, a 10 bagger. Just a few cents lower, up to a 15 bagger. That's 500% just from these price differences down here. And that's exactly what is happening right now. That's exactly what is happening right now. This isn't a mistake to buy. And it doesn't matter, again, even if you buy here, let's say you expect at least 160% return in strategic metals, assuming they don't even really make a discovery or anything like that, because and we don't go into a mania or anything like that, because then this could happen. Okay, so what happens? It's just that future expected returns just keep going up, so the buys get better and better and better. That's why I've talking about this for a long time. It's like, I'm way past the point of selling, because they're so, the future expected returns are so high right now. So it's just, it's not even a matter of selling. It's just a matter of better buys. But I don't want to gamble with the fact that if I sold here, I'm giving away let's say 2 birds in the bush. I'm letting them out in the wild, hoping to get 3 back or 4 back or whatever. If that's not greed, I don't know what is. If you would be happy with 1 bird in the hand, you get 2 birds in the hand, you let them go because you hope there's gonna be 3 birds coming back. If you're wrong, if you're fear that price is not going lower, I mean, one of these days, like I said earlier, a bottom will come, and nobody will know when it happens except in hindsight. Nobody will know. Down here, obviously, down here nobody was willing to pay this, but if they knew this was going to happen, it wouldn't be down here, obviously. It would already be up here or something. No, nobody has an idea when the bottom is in. When it's going down, it feels like it's gonna go down even more. And it's like what's fascinating right now is that since people see price going down in minors when everything else is getting sold and juniors, they think risks are increasing. Mr. Market is selling these shares, risks are increasing. Really? Most juniors are more cashed up than they've been in a long time. A lot of the good quality juniors are worth more than they've been in a long time. The gold business is worth more than it has been in a long time. A lot of these juniors aren't even close to any form of bankruptcy. It's kind of hard to go bankrupt if you don't have any debt. But people just think risk is increasing. No, you're fearing that price might go down more before they go up. But that's, again, it's like 95%. I mean, I think it sounds pretty obvious and, what to do and, obvious why people are making a mistake. But that's, you have to remember that like 19 out of 20 don't even beat an index. Because everyone thinks exactly the same when the same scenarios happen. During a crash, nobody wants to buy. But they buy up here. It's just a matter of degrees. It's like, yes, maybe someone was able to buy back here instead of here, but then they like sell down here or whatever. So they underperform anyway. I have no idea where the bottom is. I just know that the juniors are, it's like they could go down 50% more in price, but that just means that they're just gonna go up more later. So the only thing I can mess that up is if they go down now and then I sell. That's the only thing. That's the only way I could lose really. If you have a diversified portfolio, hopefully you have high quality juniors, etc. And on the point of many for some reason cannot fathom that I don't try to time the bottom. They're like, well, okay, if you're sitting on losses right now, how on earth can you make money if you're part of the downtrend? If I'm part of this downtrend all the way down, they can't figure out like how on earth can you make money. I mean, first of all, this is a trading sardine and that's not what I'm into. But the point of me being, I could not afford this. Let's take GDXJ instead. The reason why I can afford this is because I'm fully invested at every one of these points. If I started selling bottoms, I could never afford being in from the highs all the way to the next bottom. Because I was fully invested here, I could afford this. Because I was fully invested here, I could afford this. And since this was even better, since I was fully invested here, I could afford this. And I mean high growth juniors, which typically the ones that do well do much better than GDXJ. It's like I haven't sold a low. I have bought every low since 2015. I started buying here, which I thought was low. It still went down 50% before going up 500%. And I was in all this way. Just bought and bought and bought and bought, then it went higher. Just bought, fully invested all the time. So it's like, and again, people can't really fathom that because, okay, if you have a trading sardine, you're back to where you started, sure. But the thing is that if you have a sector that contains 1,000 different stocks, and every stock gets sold. First of all, right now they're being sold just because the market is selling off, not because the sector is going down. So the value in many of these juniors have gone up. Share price have gone up, down. So that's great for starters. That means that I don't think any stock I own is undervalued. On average, I expect everyone to go up, but there are degrees of uh, future returns. So let's say you have uh, let's say you're looking at, I don't know how many stocks. Right now, for example, at this point in time, there are different opportunities out there. One stock has this opportunity, one is this, one is here, one is here, one is here. And in the future it will change. Maybe we get a further crash. Let's say these two, they trade down here. But then we have one stock that for some reason one panics in, put in a market sell order or whatever, is forced to sell his part of he has big losses on his crypto or whatever, needs to meet a margin call. That goes down here. So even if I'm fully invested, and let's say my average loss on paper from this point is 30%. And if I just hold that, I'm gonna make that back. But if I take this depreciating asset in price that's down 30%, if I buy something that's down 80%, I just turned a future expected return of 50. I sold that in exchange for one that will return 700%. And that's typically why these bottoms, like I showed here, the future returns change an extreme amount from just a few cents here and there. And of course, I mean, let's say you have a micro cap that's trading at 7 cents. It goes down to 3.5 cents. That's a 50% loss. So in the short term, it feels like Jesus, 50% down. And I thought I was buying cheap. 50%. Yeah, but that's still gonna go up. Let's say 500%. You'll get that. It's just that it's down 50% before it heads here. And if you see that and it's like, Jesus, okay, I thought it was cheap when I bought it. It went down. Yeah, so now you have a 11 bagger instead. You don't need to put in a large amount of capital in that case. But the point being that every day in the market, every second, there's 1,000 stocks out there, and every stock has a different opportunity. Every stock has different risk, every stock has different future expected return. So if you have some stocks that go down to an enterprise value of 0, that basically means they become as risk-free as you possibly can get. And they could go below cash. So that makes it, then you get paid in cash to buy a company and you get everything for free. And the point is that when you have volatility like this and everything gets sold, some get sold more than others. Some are cheaper already than others that get sold. So the opportunities constantly change. So if I have some stocks that, yes, they're down, let's say 30-40%, but I see a bunch of other stocks that have no business going down, they go down even more. Then I can just reshuffle. So I mean, let's say the average stock here was down here, but there were a few that provided this future, and some that were up here and provided this future, but this was the average of my portfolio, let's say, and the junior sector overall. The more I can sell of these and get these, my future expected returns just keeps increasing. If I would have everything in stocks like this, my future expected returns would get obscene. So there's a lot of things to do when we reach extreme pessimism, because you will see price to value gaps that you cannot believe. And at surface, it might again not look like much. You look at a company like, yeah, that's, this is down 40%, this other one is down 60%. You look at it, it's like, yeah, it's no big difference. But maybe the stock that's down 40% started off as being less undervalued than the stock that's down 60%. So the opportunity difference went exponential. And it's like you can have, this is SK mining before it actually, this is also one. Why do I hodl growth, for example? Because you can afford big, declines. Nothing has happened for SK mining to the worse. The story looks better than ever. So if you bought in here, you could sit through this, and so, one of these days, if the value is somewhere around here, it could still go down here before popping up there. It's all a matter of perspective, but a lot of people buy in late, buy at the tops, only buy the tops or near sentiment highs, then they sit through this and they look at this action here and think, well, at this rate I'm gonna be, no, you should start thinking what comes after the crash. You should start thinking what happens a year or 2 years from now. It's like if you buy a stock that's trading for free right now, or almost for free, do you think something good could have happened within 2 years? Yes, I think that's probably likely, especially since the world is going to shit. It's like same for Youre. Get in a high growth stock. If you can hodl that, sure. If you look at this time period, you're starting to think like, well, yeah, my returns aren't great, and especially from this, I'm losing money. Yeah, but you can afford it if you if you had hodled a growth stock, because this stock here, Youre, was creating value all this time, and it should be way higher in my opinion. But if you hodl this, you're gonna see ups and downs, and the average will of course be like. You shouldn't look at a sentiment bottom and say that. You shouldn't look at this period and say this is how bad I am. No, you should have a longer time frame perspective and think like this. You shouldn't. Most people brag and retire when we're up here, because they see this trend. But this isn't a fair assessment, let's say, because you're always going to have sentiment lows in between. And this is, if you're just hodling, this is basically your expected return if just GDXJ keeps on, let's say, growing like it has. So this is your actual expected return curve. But in the meantime, you'll have something like this. And of course, the lower you can get in, the steeper your return curve is going to be. And the higher you buy, the worse it gets. And take this example. This is one of the hodl portfolios I manage, meaning I don't manage it that much. It's just 30-40 stocks, primarily growth juniors. With most of them have some margin of safety, like they have ounces. At least they typically have a discovery, so they have probable growth, meaning that in 1 year I expect it to be worth more than today, and in 2 years I expect it to be worth more than a year from now. So if you look at this, you're like, yeah, at this rate, this is obviously, like you see, this is it's not superb, but it's like, yeah, it beats it beats GDXJ. And again, it's like, yeah, 30-40 names, almost pure hodl, so I don't do anything really. And it's and this is at a sentiment, I can't say a bottom obviously, but at very poor sentiment levels in the juniors, and it's still up 74% in the last 3 years. But if you look at this is from the top here. It's down 30%. So again, everything is about perspective. If you look at this, you would think that, hey, you're losing almost a third of your portfolio every year. Yeah, that's true if you look at it that way. But if you zoom out, you see that the trend is up. And yes, you have the sentiment low. This is, this portfolio was negative. This was the crash. And then what came after, you were up 150%. So always think about what comes next. I don't know when anything of this will change. I just know that it will change. And I just know that juniors are absurdly cheap, and at the next sentiment high they're gonna be up a lot. They're gonna be up a huge amount. And right now everything I'm focusing on, with let's say my active semi-active portfolio, first of all, I still in my let's say larger portfolio, I'm still looking for private placements. Because can you imagine if you get into a private placement, not first of all, you give money to the company so they can create value, and obviously makes it way harder to go bankrupt if they get money. And let's say you get some warrants. I mean, look at this price. Imagine if you financed, you went into a private placement here, you got a company cashed up, and you got warrants. Maybe instead of like a 14 bagger here, maybe you got 20. Or 25, whatever. So it's like I've seen some people say, I'm not touching a private placement in juniors right now. I'm like, holy hell, if there was ever a time that I would be willing to go into a private placement with my risk capital, that would be now. And increasingly so the lower it goes. I just went in pretty big into junior financings. One I get a full warrant, one I get half a warrant. I think one of those juniors, for example, in a relatively good sentiment environment, I think that stock could be quite easily up 500%. And I get half a warrant to boot. It's like, again, like I say, people fear this. People fear this last spurt here. This last ending movement of a downtrend. Whereas I think you should be looking at the gap to the next sentiment high, and especially, I mean, more importantly, the price to value gap. So it's like if I can get warrants, the lower this goes, even better, because this delta here is just increasing. Future expected returns are going up exponentially, and that means the risk reward on warrants, since warrants is risk-free upside, goes up exponentially as well. If they just froze these price levels for 6 months, I would be very happy. If juniors traded at this level, you held price of gold stable and stuff like that, the value of the business was stable, and you fixed prices at these ridiculous levels for 6 months, I would plow and plow and plow in more capital. Because when the next sentiment high comes, I would make a truckload of money. So basically that's how I see it. There are two options. Either the gold business and or civilization is gonna go away, or one of these days, maybe 6 months from now, maybe a year from now, maybe 2 years from now, I'm gonna make a boatload of money, because I've been buying stuff that's almost for free. And when people want to buy it again, when it's not selling for free, my portfolio is gonna be worth a lot more. But that also means that, like I said, I don't like leverage at all. I want staying power. That's why I typically don't prefer companies with debt, because that is actually a risk. If you don't have debt, it's hard to go bankrupt. And if you leverage yourself, you could get a margin call. And I don't use stop losses, especially around these. I mean, imagine if you had a stop loss and you get sold out here. It's like, okay, that was probably one of the most costliest stop losses you'll ever see. Or maybe down here. I mean, there's someone selling down here, obviously. There's a bunch of people selling here. And what makes it fascinating when you think about it, let's say an enterprise value of zero. Basically, let's say a junior had 4 million in cash, traded down to like 4 million. That's a PE equivalent of zero. And the reason for it being at zero is because nobody was prepared to pay a PE of 1. That's how bad sentiment is, and how low the appetite for risk is, and how few buyers there are in this sector right now, that the juniors are trading, especially the micro cappers, are trading at a PE equivalent perhaps at 4. Some are even close to 0 already. And people think this market is hard. You can, I mean, theoretically, you can't even get a better opportunity. I mean, it's mind blowing. When you have better opportunities than you could ever ask for, nobody sees it and nobody takes advantage of it. Because they're not looking at the opportunity. They look at the risk of what they hold going down in price more. It is truly mind-blowing. That's why I think you can put me almost in any sector. I think I could make money. For the simple reason that I have a firm grasp of the obvious. And one of the obvious things is that sentiment always changes. And if I buy something for free, I'm not taking any valuation risk at all. So right now, in the junior sector, especially if it's a cashed up junior with no debt, the risks are the lowest they've been in, I don't know, like forever. Maybe not forever, but it's like way better than here, because gold price was lower. Way better than here, because here the gold business was crap. Maybe it was actually better here or somewhere. Yeah, maybe actually better. And what happened? You had a fattest rally ever. So it's like it's mind blowing. I don't know what to say really. It's like I love this market, but I don't like seeing a lot of people feeling pain, etc. But at the same time, it's like if this hodl portfolio, for example, that's down 30%. That's nothing. That's nothing. If I'm down 30%, they need to go up 50%, and I'm already break even. And I expect, like Bear Creek Mining might not be the best one because I don't own it, they have debt, etc. But it's like, this is a trading sardine, leverage trading sardine. Let's say the average return from now is 300%. And I'm down 30%. I'm gonna make a lot of money to the next sentiment high, and since I'm typically in growth stories, the next high is gonna be even higher. So it's like, in my opinion, don't sweat it. If you're down 50% on paper right now, I wouldn't worry too much about it. If you're 50% down in the stock market, in cryptos, yeah, I would worry about it, because they should go down more probably and stay down. But if you're down in 50% in something that should go up hundreds of percent and will go up 100%, that's not really a problem, is it? It's just a matter of perspective. and time horizon, and that's why you have to stick. If you're gonna try to beat the market, you have to stick it out. If I sold down here, what am I doing? If I sold down here, what am I doing? It's like, and I can't guarantee that it will go lower. Since I can't guarantee it will go lower, I know what bird in the hand I have right now. And if it goes lower, that just means that any dry powder I have will get higher and higher future returns. It's just going to supercharge. Because, of course, I mean, if you're full invested here and you have this kind of expected return, the delta here, if it goes down here, even if you bump your portfolio by like 5%, that's still going to be material boost to your future returns. Because let's say, I mean, if you have add 5% of your portfolio, it actually goes down. Let's say you were fully invested here, 637%, goes down here. Let's say a 15 bagger or something. If you have 5%, if you add 5% to your portfolio with an expected return of a 15 bagger, that's materially gonna boost your future returns. Just from that small add. And that's why declining prices, all else equal from here, this point on, is actually good in the end, even if you're fully invested. Because if you can put in any money at all, you're still gonna get this return on your original money, and you're just gonna supercharge your total return with any additional dry powder. And again, what I like to do is that, not that I technically have dry powder, but if I have some stocks that have gone in price as well, but I see opportunities like this pop up, maybe 3-4 stocks get sold to absolutely ridiculous levels where the future return is like 600%. If I trade a future return of 200% for 600, I just added 400% to my expected returns with that capital. So again, volatility is your friend. When people get extremely stupid, you will see extreme high future returns. So that's why I'm like I've said. I mean, when the market opens, let's say I have a 15-minute delay, and I don't care to click on every stock. So I just wait, a half an hour, and then I just look what prices Mr. Market is setting. So if he's setting one stock down 16%, another 4%, maybe that's an opportunity for a 12%, and that's going to be higher, since if it goes down 12%, let's say the future returns are going to be higher than 12%. But you know what I'm saying. So this time right now, this is when you set up your future. If you want to have outsized future returns, this is crunch time. This volatility, you should love panic selling. You should absolutely love panic selling, because some stocks will see more panic than others, and a great opportunity might turn into an extreme opportunity within a day. So this is crunch time. This is crunch time, because this is when the future expected returns go absolutely insane, just from small movements in terms of absolute price. But sure, it can look. If you have a 4-cent micro cap, or 1 cent down, that's down 25%. And you can be down 60-70% on a stock, and that could go up, and you'll see that a 500% profit within 2-3 years. Again, all you need to know is that at these sentiment extremes, and again, it can go lower, but you should welcome that. You should always think of the price value gap. Think of the future. What's going to happen to this stock within 1 to 2 years when things get better? What's going to happen to this stock? Have a watch list, whatever. Compare it so you can trade your currency in one stock for currency in another stock, etc. Because this is no rational selling. This is not people sitting looking at a spreadsheet and calculating that, oh, okay, I think this stock is actually worth less now. No, gold goes down 1% and you see juniors down 20%. There's no rationality about it, not at all. That's just someone making a huge mistake. And he's not going to think he's made a huge mistake if it keeps on going. But he, in fact, did a huge mistake to begin with, because he didn't know it was going to go lower. And then maybe he sells more of that stock when it goes even lower, because he's now thinking he's so smart because the last sale proved to be, quote, right, because it went actually lower. So that's just gonna reinforce his idea of, yes, okay, it's better to get out now because I'm seeing like my last sale, proved to be good because it's now down 20% more. So he's gonna be more inclined to sell. He's gonna he thinks he's gonna be able to time this, and that's when you rip their eyes out basically. Welcome, volatility. This is not investing advice. Always do your due diligence. Stocks I've talked about, I own some of them. I own SK Mining and Youre Resources. Uh, Always do your own due diligence. They're banner sponsors as well, so consider me biased. Don't risk money you cannot afford to lose. Don't risk money you need in a given time frame, because we have no idea what's going to happen to liquidity and prices, and the worst thing of all would be to be forced to sell in a liquidity crunch when the future expected returns are absolutely obscene. In my opinion, don't use leverage. Uh, think about the staying power. Think about doing anything really that allows you not to be irrational. So I wouldn't like to be in two, three, four stocks only right now, because that's gonna, you know, put on a lot of pressure, and anything could happen. Anything could happen. Maybe you have four stocks in the same jurisdiction. Something happens with the jurisdiction. You know what I'm saying? Okay, yeah. Thanks for listening. Bye.